Hello, good evening, everyone. We will be starting very, very soon. So before I start, right, so let's do a quick testing. Um, so if you can hear my voice, can you just type hi, and in the chat so that I know it's all good? Hello, Tian Kiang. Hello, hi everyone. Hello, hello, Kay-san. Hi, good evening, everyone. So we will be starting very, very soon. Okay. So today, we will be having these sessions together with Mr. Paul from Phillip Securities Research, right? Okay. So it's 8 right now. So just let me do live streaming also. All right. So it's 8 right now. Hi, good evening, everyone. So let's start for today's session. So for today, we are very, very happy to actually have Mr. Paul from Phillip Security. So he is the head of research of Phillip Security Research Singapore. So today, the title will be From Storm to Opportunity, why Singapore might be the bright spot this quarter. So I think for this year, is a lot of new tariffs, economic uncertainty, all this. But one market, right, is actually very, very standing very, very strong. So is Singapore. But later on, Mr. Paul will be able to share with us why and also what are the things that we can look forward also. So before that, so just let me do a quick sharing. All right. So today, let me just do a quick share. So this is a new platform, InvestingNote. So it's a platform that is focusing on Singapore market. So all this information inside you were able to see is on Singapore market. So this one is STI, which is a Singapore index. So right now, Singapore index is standing very strong, is 4,260. So all this is also a social media posting by the users. You can actually follow them, all right, and see what are their thoughts behind, all right. So one of the very interesting features that I want to show you is if you are new to Singapore market and you have no idea how to start, right, or where to start. So one of the ways that you can see over here, we have this investment portfolio. So this one is only for your information. You can actually go and to see what are the top performing portfolio. Then you can see we have Beanie, Joey, Kenny, and also other portfolio as well. All right. So what you can do, you can actually click view portfolio, and you will able to see their portfolio as well. So just take note, the portfolio is for information and educational purpose only. So do not constitute investment advice or recommendation. All right. So over here you can see their allocation on what stocks, what sector, what is their asset distribution right now. All right, and also what is the top 3 traded stocks, and also how the performs since the first purchase, or what are the transaction and what are the notes that they why they buy, why they sell. Okay, and all these analysis that they do for their portfolio. All right, so for this portfolio, you can actually take a look the portfolio summary, the position of summary, then also, all right. So how do you actually go to this website? You can just Google, you can just search InvestSG, then you will be able to see this website already. So there's a lot of different content. There's video, has Hang Seng Tech Index show a bullish reversal. So you can actually watch the video over here. And we just got this campaign, but it's already ended right now. Celebrate National Day with our InvestSG giveaway, win $60 fair price voucher. So we have 420 votes for this campaign. So we will be announcing a winner very, very soon. Okay, all right. So before, without further ado, okay, let me just stop share. Okay, so today let's start today, and today very, very happy that we have Mr. Paul over here to come to our investing note webinar session again to actually share with you about very interesting topics. Like I mentioned just now, Singapore is a very standing very strong. So let's hear more from Paul. So hi Paul, how are you today?
Hey, hi, Darren. Yeah, thanks, InvestingNote, and thank you everyone for joining me tonight. Taking your precious Tuesday night. Hi everyone. I think I see in the chat. Hi, Richard, Alan, Yemi, KS. Yeah, hi. Thanks again for joining me here today. Okay, can I
Yeah.
start,
So
Darren?
let's say if you have any questions, you yes. So let's say if you have any question later on, you can put into the chat or put in the Q&A. So if let's say later we have more time, then we can answer some question also. So pass the time to you, Paul.
Okay, yeah, thanks again, Darren. I'm just a bit wary of my Wi-Fi connection, so if there's any issues, do feel free to just type in the chat. Maybe I'll just switch off my video if there got any quality issues. So for us, when we did our third quarter strategy, it was essentially going local. Partly you have this Superman picture because Superman was just being screened in the cinema. Of course, it's over right now. But I think our emphasis is that we do see returns for Singapore investors. That's what we mean by going local. On this slide, again, we still have to go through the typical disclaimer. This is purely for educational purpose. No, the information that we take, no, is from public source, so we don't really have to we don't really verify whether any central bank, any third party issuing Bloomberg data, no, we can't verify the accuracy, and we just assume we are taking it. For general circulation, and do seek advice from your financial advisor. As some of these recommendations we may change our minds in between, and you may not be immediately informed, and some of our stock recommendations may not meet your needs. Okay, so that's it for the disclaimer. So let me just run through our agenda. I will have a quick brief on the 2025 performance. I'm assuming most of the attendees are actually from Malaysia, so we will do a bit more foundation in our presentation because I'm assuming the majority are Malaysian. So if there are some Singapore attendees, I apologize. I think because we are catering more for the Malaysian attendance. So the second part will be just why we think Singapore is not just a safe haven, but you actually can get a satisfactory return or a safe return, and we'll give some explanations. We will give more slides on the two key sectors in Singapore. So banking and REITs is a two key sector. If you look at the Straits Times Index, I think banking and REITs easily takes up about 70% of the index. Then we will run through the various stock picks. No, feel free to ask me any stock or any sector because we do have quite a wide coverage. And the final part will be just on our absolute 10. So we actually do have a model portfolio of 10 stocks. Absolute is supposed to be absolute return. It doesn't happen all the time, but that's ultimately the objective. Okay, I'll just run through on the review of 2025. Okay, so two-thirds of the index in general so far have enjoyed gains. I took it from yesterday, the performance, and then yesterday was actually a big perform. The market was big yesterday, so it could have been higher. But so let me just run through with you on your very top left. What you see are the banks. So because banks is almost 50% of the index, you will notice that DBS has been the clear outperformer. In the beginning, OCBC and UOB were performing well, but I think what happened was when Trump had the tariffs, then I think a lot of the banks, when they started to release their first quarter results, they put in a lot of provisioning in the second quarter, third quarter. Like DBS even has provisions that they put in for the pandemic, about 2 billion of provisions for the pandemic. They have not even reversed. So the Singapore banks have a lot of provisioning. But why DBS did particularly well is because they gave a dividend guidance that was fixed. So they gave like a fixed 24 cents increase even in 2026. So that actually put the performance, whereas the other two banks, the dividends has been more a percentage or payout ratio, which is depending on earnings. So that's why the performance may be weaker because there's less clarity on the dividends. If you look at the best performance, pardon, there's a typo here. It's not Jardine C and C, it's Jardine Matheson. But if you look at some of the best performing stocks in Singapore, in terms of the large cap at least, you'll notice ST Engineering has performed well. And as the title suggests, ST Engineering did well because the whole defense industry was lifted up. I think the valuations are now hitting almost 30 times. Today it was down, so you're talking probably like 27, 28 times PE. It used to trade at maybe 20, low 20s. But as we saw what happened in Europe with the conflicts mushrooming in Ukraine, and then with Donald Trump coming up and asking, with Germany raising and the whole of Europe raising their defense budget, it kind of re-rated the whole defense sector. We recently downgraded ST Engineering because we think the valuation is a bit steep right now. DFI is basically, they used to be called Dairy Farm. So they did really well because I think in Singapore, one prominent theme in Singapore is if you're selling assets, you get a big jump in the share price. So for DFI, which is your cold storage here in Singapore, and also your guardians in Malaysia and so forth. So what they did was they sold off the Singapore, their loss-making retail or weaker performing retail in Singapore, and they also sold off one of their Yonghui, which is their loss-making supermarket, and that actually turned around the company and that lifted up the share price. Jardine Matheson, sorry, not Jardine Cycle Carriage, is just a holding company for DFI and also holding company for Hong Kong Land, which also performed really well because they were selling assets. So in Singapore, dividend yield works, and also another thing that works is if you sell assets. The worst performers in Singapore in terms of the large cap has been Thai Bev. I think this is in line with the whole Thai market, which has also been performing. Until recently, there was a big bounce. SETS, another victim of Trump's the trade hangover. I think with the uncertainty over tariffs, so SETS was also hit. Mapletree Industrial, one of the worst performing REITs, is mainly because they have exposure in China, and they are facing negative rental reversions in some of the, especially the secondary cities in China. Some of their industrial warehouse properties where there was a bit of overbuilding because of the whole e-commerce boom in China. So they got hit with that. But REITs are recovering. You'll notice quite a number of them are Singapore-based because in Singapore, interest rates has generally halved. We'll talk about it later. So I'll move on a bit to just on the asset classes that have performed so far this year. So Singapore, this is in US dollar terms so that we get a better comparison. So you notice that this is Singapore STI, and that actually performed really well. This year we're up almost 18% in US dollar terms. I added KLCI here since we have a Malaysian audience. But as the title suggests, what has done well has been gold, which is, I think the last 2 years is basically 50%. And this is not the gold price, this is actual ETF. So you actually can realize such a return. Of course, this is in US dollar terms. So in other currency terms, it may be smaller. And Asia has done really well. So this year, Asia, like Singapore, Asia Pac ex Japan has outperformed the US markets. Yeah. And we continue to be more positive on the Singapore market. Move on to the next slide. So this is my last slide on just performance. I mean, we don't want to dwell too much on performance, but just to give you a sense, what are the stock markets in Asia that has performed well year to date up to Monday or yesterday, and this is in local currency terms. So, like we mentioned, one of the reasons Thailand has performed well has become, as we all might have read in the news. I mean, Thai Bev is down because Thailand, you can see all the political issues, the tariffs, and so forth. So there's been a lot of, and also the muted tourism because of the Chinese tourists are a bit more wary, I presume, coming into Thailand. So that's why North Asia has led the gains in Asia, South Korea, Vietnam. Like we mentioned, Singapore small cap has done really well, and you see this big move, and we think it's only starting, and we'll give some explanations why. And you'll notice that the performance only started in the last 3 months. Indonesia, Singapore is also here about around 11%. So this is Malaysia, just for your reference, and the whole ASEAN or Singapore REITs, India, Taiwan. Okay, so let me just go through. We have like 5 reasons why we still like Singapore, and where you can get some safe returns. Okay, so the first thing that is happening is that is among no, Singapore is still the only Asian country with a AAA credit rating. I guess that comes to more prominence since the US has lost their AAA credit rating. So this chart you see here, the blue line is actually the foreign reserves of Singapore. So pre-pandemic, Singapore reserves was probably around 300 million, just to round it up, US dollar, and the flows were up and down, so it was quite flattish pre-pandemic. But when the pandemic happened, you will notice there's a huge influx of liquidity coming into Singapore. You notice here about 82 billion and 56. There was a bit of outflow here. I guess we saw probably there was some. I guess we saw some prominent news on some Chinese individuals, so that might have triggered the outflow. You notice I put in bracket, but there was a big inflows back into Singapore in 2023. You notice I have two numbers here. One is 61 billion, which is the official blue line here, or the red line here. This is the cumulative. And the one in bracket is because what happened was up to the last 3 years, because of the huge influx of liquidity, the MES has actually transferred almost 200 billion to GIC. So otherwise, in actual fact, the foreign reserves of Singapore right now should be almost reaching, if you add back this, is almost 600 billion. But because we transfer some of it to GIC, because I think the inflows was just too heavy, and then we could pass it on to GIC to better manage these reserves. So that's why when you notice this bracket, what it means is that we actually add back we kind of guess the amount that was transferred to GIC. So that's why even though it's 400 billion, it looks like it's below the peak, it should actually be up here around 600 billion. So since the pandemic, the reserves, foreign reserves of Singapore has actually doubled. And we'll talk about it more in the banking, how it actually affects the banking sector. So one of the positives in Singapore is we continue to get a huge influx of liquidity. And the second positive is while the world is waiting for the Federal Reserve to cut rates, so this is SOFR. This is like short-term interest rates in the US. In Singapore, we call it SORA. Yeah, I think in Malaysia could be called CLIBOR. And I'm sorry if I got that wrong, but anyway, this is the short-term interest rate. So over the last 12 months, what we've seen in Singapore is that the interest rates have actually halved. So that's why it used to be 3.6, 3.7. Right now, the 3-month SORA, which is we use 3 months because 3 months is the rate where most of the banks, most corporates borrow at the 3-month, or even the REITs borrow at the 3-month rate. So basically, the point here is that interest rates have halved in Singapore. So that's why it should prop up the equity market. It should prop up the property market, as I will elaborate later. And of course, it's now also propping up some of the REITs as they now pay lower interest rates. So what you notice here is that even though the US hasn't really dropped their interest rates, but because of the huge liquidity coming into Singapore, and Singapore interest rates is actually impacted partly by currency expectations of the currency. So that's why it's a very vibrant market now, because inflows are in and also interest rates have halved. And of course, again, this is because we are pulling a Malaysian audience. So this is just for your reference. If you look at for Singapore, we don't have an interest rate policy. So the central bank or MAS doesn't have a policy to cut rates or lower rates like Bank Negara. What they do have is they will only adjust the currency. So officially for Singapore, our default policy is to have a gradual appreciation of the Singapore dollar, which is this blue line. And it is a gradual appreciation with all our trading partners. It can be the renminbi, US dollar. No, it's a basket of currencies which they never disclose. I added in Singapore dollar compared to the ringgit, the appreciation. So long as Singapore continues this blue line, then of course we can't predict how Singapore and ringgit will perform. But if you're a trading partners, by default, the MAS only wants to raise the currency, appreciate the currency gradually against all our Asian neighbors in a way. So if you want to guess like how much has historically been, so over the last 10 years, Singapore dollar has appreciated against the ringgit around 2.2% a year. Again, it doesn't mean that this will happen again in the future, but this is just historically what has happened. So I guess if you're investing out from Malaysia, this will be more meaningful if you park money into Singapore dollar. Then of course there are also multiple sectors in Singapore performing well. Of course, the banks are stable. property, construction commodities are also doing well. I'll talk about it more later. The ones that we are neutral a bit is maybe on electronics. We'll have one stock later. Healthcare and also retail has been a bit slow, and telcos is also a bit slow because there's a price war in Singapore right now in mobile competition. Not sure why. There's effectively still four operators. Tourism in Singapore is a bit slower now because last year we had so many concerts, so year on year is a bit slower. And of course, transportation is a bit more uncertain because of all the tariffs happening. But the two sectors that is very hot right now in Singapore, which is helping especially the small mid cap, has been the construction sector. So if you look at this blue line, so blue line is actually the construction that's awarded. So these are contracts awarded by the public sector, can be which is the government, and also the private sector. You know, if you're building an industrial building, or you're building a office building, housing, if you combine, this has been this up around the last 2 years. It has been going about 30%. So the amount of contracts being awarded is 30%. And also it's at the record high right now, probably around 52, 53 on the 12-month. TTM means trailing 12 months. And this is even before the two integrated resorts coming up. So the Marina Bay Sands and Genting are spending, I think, around US or Sing dollar, just US Sing dollar, around 8 billion for each integrated resort. So this contracts are even before that, and the massive, I think 30 billion T5 construction. So there's a lot of MRTs coming up in Singapore, a lot of highways coming up, and of course we also have the 100 billion coastal protection, which it will be progressively deployed. It won't be like immediate. But this is the reason why construction activity is booming in Singapore, and that has actually helped a lot of construction stocks. We'll name one or two of them later. The red line is just payments, because once this is actual work done, you could say, because it's only when you do work, of course, you get paid. So this is of course always trailing, but this is just for a reference. You can see the big spike in construction awarded, and that has helped the industry significantly, including building materials, including workers' dorm, and so forth. Okay, this is a very noisy chart, so apologize for that. But what we're trying to show you, the red means what is happening. When you see all these red lines here, means that the government is coming in to cool down the market. So here means additional buyer stamp duty. So this means that the authorities have raised the stamp duty, especially for foreigners, to 60% recently. Yeah. So what happens is that if you actually buy a property, if you're a foreigner, you want to buy a property now, assuming the property is 10 million, you have to pay another 6 million on top of that 10 million that you're paying, because any foreigner has to pay 60%. Obviously, this has totally shut up the market, because no foreigner will want to buy, because even after 10 years, if you assume property price is up 6%, you technically just broke even. But what you've seen here is this is the primary residential sales. Sorry for a typo here. So this is new home sales excluding executive condo. So you will notice there was a big jump recently. So the amount of new home sales this year, that means new property launch, is up almost 124% year on year, up to July for this year. So the property market is turning very vibrant. I think that's why you see this big spike here. We play this through some developers, or even in Singapore, we also have two large real estate agencies, which is a cleaner way to play, because you're just playing on the volumes. So the other thing that's helping there is another sector that's performing very well, apart from construction, has been the property sector. And of course, it's positive for the whole Singapore economy. Then loans growth there'll be loans growth and so forth. And of course, some of the reasons why property is doing well, because of the exit of, or the non-involvement of foreigners, a lot of it is coming from Singapore residents. And if you notice, household debt to GDP is still very low, so it's only about 52%. So that's why Singaporeans are actually buying a lot of properties now. Even though the prices on average unit now for mass market, if you want to call it mass market, it's about the average price now is about 2002 to 2004 per square feet. So if you take it in ringgit, you're talking probably about 8,000 ringgit, 7,000, 8,000 ringgit per square foot. So this is the mass market. If you want to go high end, you will cross 3,001 to 3,002 Sing dollar per square feet. So of course, it is not just the property that's doing well. I mean, because there's a lot of jobs, there's a lot more population. A lot of parents are also buying. It's a bit um, of a transfer of wealth by generation. So most parents are transferring some of their wealth to the next generation by helping top up property, by helping, putting up deposits. Of course, it didn't happen to me, but anyway, this is for other. This is one of the main buyers has been wealth transfer by parents. Okay, the other thing that is performing well is the valuation. So even though the market is up, it's still trading at the average. So we are not trading at maybe even at the highs. You're talking about maybe 15, 16 times, because the market, Singapore market only broke its all-time high, 17-year all-time high only recently. So after 17 years, we are technically only up maybe 6-7%. So there's still a lot of room to grow for the Singapore market. So this is the average valuations. If you look at the yield, so because interest rates in Singapore have dropped so much, if you just take at the yield of the Singapore market, which is around 5%, because banks are giving you 6% dividend yield, so banks are like the REIT killer. Compared to what you're getting from FD rates, we call it 10-year government bonds, but you can use FD rates or Singapore saving bonds. The market is cheap because there's a huge pickup by buying the dividend yield stocks in Singapore, compared to parking your money in fixed deposits or some of the bonds that's trading in the market right now. So that's how to understand this particular chart. Okay, so this is my last point of why Singapore is doing well. That is creating the huge momentum is because there's a huge capital injection. So for the Malaysian audience, so in Singapore recently, there is this EQDP. So the MAS, or the Central Bank of Singapore, has mentioned that they want to inject 5 billion into the Singapore equity market, and this 5 billion Singapore dollars is targeted more towards small mid cap and also non-REIT stocks. So if you do a rough computation, you will notice that if you take all the stocks that are non-index and excluding REITs, it is almost 4% of all the stocks. So this is a meaningful amount. So this is a meaningful size for 5 billion. And if you free float adjust, because some of these stocks are have major shareholders that are not selling, it's almost 10% of all these stocks. If you do a volume adjusted, it's almost 18%. So 5 billion can actually go a long way. We don't think, from what we understand, so far almost 1.2 billion, I hope I get the number right, 1.1 or 1.2 billion has already been farmed out to fund managers. But what we understand is not all have actually moved into small mid caps. They actually do park some of the money into index stocks, from what I understand. But regardless, I think the main point of what we're trying to say is that the 5 billion has a meaningful impact, especially for the small mid caps. So how to understand this chart is that if you take the Singapore stock market, those 1 billion and above, it's only 35 companies. So it's so we don't really have many stocks that are above 1 billion or equal. And if because a lot of these are REITs, so if you exclude REITs, it's only 35. If you include, although you get a lot of companies less than 1 billion, should be one here, sorry. But the size of it is only 52. If you volume adjust it, because some of them hardly get traded, it's only 5 billion worth of stocks or so. So it's a very thinly traded, less than 1 billion, and that 5 billion can actually be quite a significant sum. Just to understand this chart here. The other thing is that it is not only MAS that is contributing money. We also have DBS, partly owned by Temasek. That's why we put GLCs. That is also returning a lot of capital. So on top of the ordinary dividends, DBS is giving out special dividends. They call it capital return because they have too much capital. So the next 2 to 3 years, they are returning almost 6.5 billion, including the 3 billion of share buyback. Likewise for Singtel, they are selling assets and they're doing share buyback. So on top of this 5 billion, there is a lot of the corporates themselves are also buying back a lot of the shares. So there's a lot of liquidity being injected back into the market. We also seen separately more and more small cap funds being set up in Singapore. Likewise, we also seen some of the indexes coming up, so that ETF providers can create an ETF around small mid caps. So what we're just trying to say is, although only 1.2 billion has been, this I can't get the exact number, is it 1.2? But the remaining 3+ billion will be farmed out to fund managers by the end of this year. So not all 5 billion is out yet. So only 1 billion has been out, and that was only a few weeks ago. So you should expect another 3 billion to be deployed by the central bank to the fund managers by end of this year. And that's why the market has a positive runway for the next, at least the next 12 months, because all the money hasn't been farmed out yet. And hopefully this creates a virtual cycle where more funds will be created and then more indexes will be created, thereby you actually create ETFs which can actually be deployed back into the market. So liquidity, okay, anyway, in a nutshell, having said so much, the liquidity is coming back very strongly to the Singapore market. Okay, I'm just going to run through for Singapore banks. So for Singapore banks, for the Malaysian audience, we actually have 3 big banks here. So this is just a quick review of the performance of the 3 big banks. So what has hurt the banks has been NIMs, because as interest rates fall, actually the banks suffer. Because a lot of the banks, they have very high excess deposits. They collect more deposits than they can lend out. So of course, all this excess liquidity goes into, can be bonds, can be money market, can be short-term securities. And if interest rates come down, of course, they can hurt. DBS was hurt the least because they managed to park a lot of the money, especially their US liquidity, into long-dated government bonds. And also one of the reasons, so the other part that's doing well, the only part that's growing for banks right now is the capital markets. So that's why fee income is growing. It can be wealth management, it can be stock market. As the market gets more vibrant, the wealth managers can sell more and more investment products. And but all the banks are still paying very attractive yield, about 6%. And that's why it's sometimes very hard to broke Singapore REITs when banks are paying 6%. Yeah. So when clients just say, why don't I just buy a bank? You find it a bit difficult, especially for DBS, where they are already guiding 2026 that they will raise their dividends by 24 cents. The other thing that's positive for Singapore banks is loans growth is coming up. So in the last 2022, 2023, loans growth was virtually negative. It was contracting. But this year, this is a chart from our banking analyst. You'll notice that loans growth, the total loans is actually growing, is actually climbing back up to 6%. This is the highest in the last many years, up to since 2022. And with the vibrant property market, construction sector, and with REITs starting to make acquisitions, you should expect loans to continue to climb higher. So this is going to be the positive that can kind of offset the weaker interest rates in Singapore. The most important thing for a bank is always CASA, which is the current account and savings account. Why this is important is I mean, the banks don't pay anything. It's virtually free money for the banks. They don't pay on current account, and they pay such a small amount in savings account. It's hardly noticeable. Well, I'm talking for myself. So, but what you notice is that CASA is growing back very strongly. So deposits, although it's called deposits, but in reality, these are actually like loans given to the banks. One way to understand it. So what you will see is that banks benefited as there's a lot of CASA, and also DBS, although it's not in this chart here, but DBS is enjoying a lot of flows liquidity recently in their recent call. So when CASA goes up, it also helps them because you don't have to pay, or the interest that you pay for current account is zero. Then you can just take the money and just deploy it in the SORA, which is 1.7, 1.8%, and you get a free carry from it, because you take zero and then you just pocket 1.5, and it doesn't hurt your capital. Yeah, sorry, it's a bit technical here, but what I'm just saying is that the CASA is helping the banks, even though NIMs are coming down, but it can help grow the volume in terms of the net interest income. This is just to show that volatility is helping. So on the SGX, the volumes is up about 15% and DDAV about 14%. So although the NIM pressure, but the capital markets is helping fee income for Singapore banks. And the bank that we like so far is DBS. So the blue line here is the payout ratio. If you include the special dividend or capital return, they are paying up almost 80%. And they are already guiding 24 cents increase in 2026. So you can assume that there's a firm 6% yield for DBS even up to 2026. If you remove the special dividend or the capital return, they are still paying around 5.2, 5.3% in dividend yield. So that's why so the dividend yield, which is something very smart by DBS, is actually supporting the share price. Because I mean, if DBS share price were to come down and the yield hits 7-8%, then obviously investors will come back in. So the yield is actually supporting the share price too, or defending the share price. Okay, let me move on to the next one, which is Singapore REITs. So for Singapore REITs, let me just touch the index has been performing quite poorly. If you notice there, since the peak, it has been on a declining trend, partly because if you look at dividends, so dividends has been contracting for Singapore REITs, and that's because interest rates shot up. So of course, when your dividends are contracting, investors will kind of had a major de-rating. But what we do see now is that it's starting to stabilize, and we expect dividends to start to grow. So for some of the Singapore REITs, what we do notice is that the dividends are starting to grow to even 5%, 10% because interest rates have come off so much. Of course, Singapore REITs in terms of valuations, price to NAV is still extremely cheap. You're talking about 0.8, 0.9 times compared to the historically about one time price to book value. So let me try to recommend some REITs that we like. So this is called a Stoneweg European REIT. Although it's a European REIT, it's actually listed in Singapore. It's paying 8.5% yield. So of course the one risk factor here is that they're paying in euro, but because the yield is so high, we like it. They have almost 104 properties. Most of it is in Western Europe. You're talking about UK, France, Italy, and so forth. A large part of it is logistics and also the office. So this stock has been when of course it been hurt every feasible way. So of course, firstly you have the Ukraine war that caused the stock to sell off. Then interest rates shot up, that caused the stock to sell off again. And then of course, with energy price surge and everything, that of course caused the stock to surge off because people were worried the whole industrial sector might leave Europe. But they managed to be very resilient. The portfolio occupancy we think has been stress tested. I think this is just a temporary bump because they had to do some AEI in one of the properties. And the most recent results, they are enjoying a 15% rental reversion. The share price has still been a bit sluggish because they were still enjoying very low cost debt. Because in Europe it was negative interest rates. But we think they have passed that, and we like it because basically this is a portfolio that has been stress tested. There's even been a war in Europe, and of course hopefully the war ends. But even with the ongoing war, the portfolio occupancy still managed to hover between 195%, and even the office is still about the high 90s, around the 90%. So we still like it, and because it's paying an attractive yield, we think this year will be the last year where the impact of the high interest rates will happen. And then as you know, the ECB has been cutting interest rates last year and this year. So we think this will flow through into lower interest rates next year. And we think the yield is very attractive, about 8% yield. The next one that we like is Capital Escort Trust. So Capital Escort Trust they're paying a yield about 7%. They have they have a lot of units. So there's many service residents and so forth. They got like 101 properties, largely in developed countries, including Singapore, Australia, a lot of it in Japan too. And they are mainly into service residents, hotels, and rental housing. So apart from the yield, of course, this year we know that tourism may be a bit slower this year, but why we like it is that they have 300 million of undistributed gains. So one unique thing about this company is that a lot of their properties, because they managed to invest in all these locations, I don't know, maybe more than 10 years ago, and they got very prime locations. So that's why like we always joke, either the valuer has got it wrong, or there's something wrong with the valuer, or they managed to sell a lot of their assets at 100 to 20% to even, of course, 5% is normal, above the book value. So book value means the recent valuers valuation. So it's because they are very good locations and they have like 300 million. So even though if dividends were to come off a bit, they can always top it up with some of the gains that they enjoyed without even having to without even having to they can top up the dividends by some of these undistributed gains because they sold so many of these properties at huge gains, which they can use up to kind of maintain dividends. And although they got 18,000 units, their parent, which is Escort, has about 100,000 units that they can acquire and grow the dividend. So the dividend per share or dividend per unit, sorry. So that's why we like it, the attractive yield and some of the good locations that they have, which we can't show you on the map here, obviously. But if you look at the kind of huge gains that they can sell, 40%, 50% above book, it just shows the great locations that they have at most of the properties. This is the final REIT that we have. You notice we like a lot of overseas ones because we think the Singapore ones, the yield is not that attractive for us. So another one that we like is Elite UK REIT. So I think if you have a child that is studying in the UK, maybe this will be applicable for you because this pays in pound sterling and the yield is about 9%. So they have about 150 assets and their customer is actually the government. So a lot of this is kind of like lack of better word, more a bit like shop houses kind of, or shop houses kind of properties in a way. Of course, not all of them, but I'm just trying to make it more identifiable. But because these are used by the UK government where they deploy pension, it's like a social, it's a place for old people to come collect their socials. That's why it's a very long-lasting kind of assets. They managed. I think they were impacted by 12 of the assets surrendered to the government, but most of them they managed to take back these assets and sell it at a higher price again because they got very good locations, and they even one of them actually they're converting to a data center which they will probably sell. So we like it because it's trading at even now still below price to book, and the dividends of 9% will be stable because it's only in 2028 where they will have to do another renegotiations with the government on extending the maturity. Of course, only then maybe investors might get a bit nervous whether they can renew, but this is 2028. So by then you already collected, I don't know, 2 or 3 years of 9% dividend yield. Okay, I know I've got 20 minutes left. Yeah, thanks, Chin Huat. Yeah, it's 1.1 billion. Sorry, I keep thinking 1.2. Yeah, that was been farmed out. So let me just run through some of the stocks we like. So the other stock that we like is City Development. So for City Development, I think the key thing is that so City Development, for those who may not know, they are actually one of the big private property developers in Singapore. They have about 26 billion assets, and they are into multiple assets. They are into hotels, in investment properties, mainly offices, and also in residential property and so forth. Let me just, and they are in Singapore, UK. So one of the key things is that they have at least another 2 billion of assets that they are property to be sold, or they recently sold 2 billion, so they will recognize the earnings. They have a resilient portfolio. Recently, they sold some properties in Singapore for almost 1 billion, and they will pay special dividend for that. Their NAV is about $14, so we are giving them a huge discount to book. Hospitality will be a bit soft this year, but the key thing for investors to watch is that, like what has happened to another stock here that's done well, is called capital recycling. So what we want to is that they are selling a lot of assets. So recently they sold South Beach 1 billion. They probably paid that special dividend at year end. They still have assets to sell in the UK. They will probably might do a REIT in the UK, and some land bank in UK they want to sell, and they're probably going to launch a very big residential project in Shanghai too. Of course, you'll be wondering why should we be worried about Shanghai? No, the Shanghai properties are selling out like almost 70% sell-through rates. So we think it's a way to play the whole property sector and also the whole capital recycling that they are progressing. Because if you follow capital city development, there have been some internal issues last year, or early this year, and the stock was sold down tremendously. But right now, I think it's recovering because property market is doing well. It's a really deep value stock because of their RNAV is almost about $14, and also they have a huge portfolio of stocks, and more important, they are willing to kind of recycle the capital. I will move on to the next one that we have is CNMC. It's actually a Malaysian company. So that's why you see the Malaysian map here. So they are actually gold miner in Malaysia. the share price has done really well. I think it's probably up I think easily doubled this year. It's not only because of the high growth price, but because they are raising production about 20, 30, about almost 40%. So when we initiated them a few months ago, it's not so much about our view on gold price, but because we were quite impressed that they're going to ramp up production. So that's the key for us. So this is the big the jump in production. There's going to be another jump expected in FY24 and 25. And this is the gold resources. And okay, so this is a clearer picture of the production that's coming up. You'll notice that they gave a special dividend as they continue to grow their production here, which is in the red line here. So for us, we call it a leverage bet on gold. So even though gold may be stable, but year on year is probably up about like we mentioned about 20% year on year, and then they are growing their production another about 20 to 30%, depending on the gold quality. Sometimes you can't be exact about it. So they're going to get like a 40. Their recent results, I think, tripled. So we expect another strong results coming up in the second half. So what we mean by a leverage bet on gold is because gold price might go up 20-30%, but their earnings can double to or triple. So that's why if you're still bullish on gold, and you can get a yield from them, so they're paying like a 5% yield. As we all know, we can't get any yield for gold. So this is like that's what we mean by a leverage bet. Of course, conversely, if gold price were to come down, then of course you get the decline. But for us, we still like them because there's a buffer about 20 the growth in production for them, which is about 17.9 thousand ounces to 21,000 ounces. Yeah. And they are going to have another underground gold mine in 2026, which will carry the production for the next few years. Obviously, underground gold mine will be more expensive, but I think this is where they can grow where this is the opportunity for them to grow multiple years. They are using Chinese resources to kind of do this underground mining. Okay, the other one that we like, of course, it's strange for us to kind of keep on recommending. So this is another commodity company that we like, which is Geo Energy. It is not just about the production, which this year they are going to double the production, but it's mainly because of the new mine that they're going to have. So this is the existing road that they have. So they're going to build a new 150 million road, and this will make them into an infrastructure company player. So they are currently producing this year production about maybe 10 to 11 million per year. But when this road is built, this road alone can carry about 50 million metric tons of gold per year. They were only going to use up half of it, 25. So what it means is that the production can jump to 25, and also that other 25, they're just going to rent out the road and collect toll on it. So they can collect, if you assume $5 to $10, this is pure profit for them. So it's like 250 million revenue. Because there are other gold miners around this area which can use the mine. So they will move from here, they will ship it out here. This is an illustration of the road and the illustration of the jetty. Okay, the next one, I'm just going to rush it a little bit now. The next one that we like is Keppel. So among the large cap, is unique because they are moving into a new business which is asset light. So they want to be a fund manager which can get higher valuations. So why we call it they have growth, because they are going to get a new power plant, 600 megawatts in the first half. So this, when you have any new power plant, earnings is just going to jump. So this will cause the big jump in earnings in 2026. They completed a submarine cable where they will earn a maintenance fee and also they have a part ownership in this. They have a totally new office building, Keppel South, that's going to be fully tenanted out end of this year. So 2026, you're going to get the kick in earnings. And they also have 14 billion of assets they want to monetize or sell, and they will pay out special dividend. So that's why for 2026, this stock we think will be one of the big outperformers in 2026, because they're going to get earnings growth and you're going to get monetization of assets. So when you sell 14 billion, of course, you're going to do some special dividend. In terms of construction, our preferred play would be Solbil. So they have a huge order book of about 1 billion. What they do is they specialize in constructing towers and buildings, and they also have a precast concrete, which precast, I think for those who may not know, it's like a Lego block, no? Yeah, but they don't do the toilets and all that, no, because that may be loss making. So they do the floors, the pillar, the side bars, the ceilings and all that, so that you don't have to build brick by brick. So you send them to HDB, and then HDB will just assemble it like a Lego block. Their earnings, I think, jump, I think 40-50%, if I'm not mistaken, and they have another 1.1 billion order book, which is I think 3 years of orders. And second half, I think they're going to be they're probably bidding for another 1 billion orders. So we think, and the PE for this stock is only, I think, 7-8 times PE. So that's why we think this stock can run, and we are positive on it. Because it's probably one of the cheapest construction companies out there right now. And so for semiconductors, the one that we like is Franken. So it's Singapore-based. They have 18 countries. I won't go through. So their largest revenue contributor is actually Applied, which is ASML. So for those who may not know, no, ASML, they are virtually a monopoly. They are lithography. So if you look at the semiconductor, there are many lines on the wafer. Microscopic and like 2 nanometer. You probably can't see them, but you obviously cannot see them. But it's like taking a picture. It's like putting a screenshot. So one of the major customer is ASML. And for us, we think they will benefit from ASML, which is essentially a monopoly. So for ASML, they are getting getting ASM. They do project. They produce ASML's most latest advanced semiconductor, the EUV, and in Europe. But they're also asking ASML to actually bring some of the production in Asia, and they will be the key supplier for ASML. So for us, that makes them unique. And of course, another new customer that they have is Applied Materials. So that's why for us, among all the Singapore semiconductor stocks, I think we like them the most. And they are trading at probably 14 times PE right now, or 13 times PE, or around 14-15 times PE, which makes them one of the cheapest among all the various semiconductor stocks. So I think just nice. We got another 10 minutes. So this is our model portfolio. So this is a model portfolio where we're not going to put the highest growth, highest risk stocks. So we try to balance it with some yield names, some that have earnings growth. Of course, some have done really well, like Propnex probably doubled, and then some re-rating, like CDL, we think is re-rating because they're going to return capital to investors, and then there's a re-rating. WeHer and so forth. WeHer, you notice, is below our target price because we are still waiting for a briefing for them before we kind of put an update on our target price. Again, this is not just about returns for us. This is also about accountability, so that if anything doesn't go well, of course, if it's up, you don't have to ask us. But like if it's why this stock is down, why Semcon is down, then every month we actually would bring this up so investors can kind of question us. So this is just a track record of the performance. Yeah, it's not meant to be a high growth. It's just meant to be very balanced. And SING basically means it's the STI. And again, so this is just a conclusion, some of the summary. We still worry about trade war. So that's why we're not very big into semiconductor stocks, if you notice from our model. But we think Singapore can shield it because we have the resilience. We got domestic sectors that are doing well. And we think the impact of tariffs hasn't been felt yet in the economy, and we favor some of these stocks, and of course small caps, because there's going to be basically liquidity coming in. There's going to be like 3 billion worth of buying coming in for Singapore stocks. So why not be ahead of it, especially for small caps? And okay, so we got 2 QR codes here. So this is our community. We have a P3 app where you got community, you can ask us questions, and every Monday, we actually have a webinar where we'll talk about Singapore and US stocks. Not just me, you'll probably be bored listening to me, but it's also including all our analysts. Okay, I think I can stop share and yeah. Okay, yep, okay. You want to take the questions, or Darren, you want me to kind of answer them? I'm comfortable with anything. Yeah.
So there are a few questions, right? So the first question is, can you briefly comment on Food Empire, especially the redeemable exchangeable notes that will dilute the existing shareholder, because their conversation price is way below the present share price. you have any views on this?
Yeah, sorry, I didn't really follow this particular. Yeah, apologies for this. I didn't go for the briefing, so I didn't really cover. I can't give you a good answer for that because I didn't really see this. Yeah, sorry for that. Inquiry. Yeah,
Okay.
I need to study this. Otherwise, I give you a wrong
Yeah.
answer if I do
Uh,
not know. Yeah.
okay. It's fine. So then the another questions from the chat. Most of the stocks recommended has quite a, you see more upside on this part.
Yeah, we do because like we mentioned, there's a lot of liquidity haven't come into the market. Yeah, that like someone corrected me is 1.1 billion. So there's another 3.9 billion that's going to come into the stock market, and we think most of this will be targeted at small mid cap. That's why what you'll notice is that the valuations in the past, small mid cap stocks probably in Singapore trade mid single digit to high single digit, and then some will be at low teens. Some of the semiconductor ones will be maybe mid teens. That was the most some of the small mid caps because there wasn't liquidity. Nobody was interested. Right now, we do see stocks moving up to 20 times PE. Some even at 30, but that's rare, but we still do get that. So what you're going to get is a valuation uplift. And of course, the question to ask is that will this collapse? We don't think it will because the money is circulating inside. So I mean, these
Mm,
fund managers, once they're in, they're not going to, they can't sell and then just give back MES the money. So they're probably going to be, the money is probably going to be circulating among the small mid caps, just rotating between one high PE to another high PE stock. So that's why you'll get, that's why when any mid cap stock has earnings growth, you're going to get the double whammy, of course, the usual the PE expansion, and then of course you got the earnings growth. So that's why someone like Propnex did so well because they got the growth and then the PE is expanding. They used to be like 13 times PE or 15, now it's hitting like 20 times PE. So we still think there is of course those that hit our target price will be a bit more wary. So like
mm,
Sawbill is trading less than 10 times. Yeah. So yeah, anyway, our target price is rolling 12 months. Yeah.
mm. All right. So if you have any questions, feel free to put in chat or the Q&A. All right. So so I think currently we have few minutes left. So
Yeah, there's one
if
question.
you have
Dividend
any,
in foreign
yep.
currency have to convert to Singapore? No, no. Yeah. You don't have to. Yeah. Yeah. I mean, if you have a bonus account, you have foreign currency accounts, so that's fine. Yeah.
Yep. Thanks, Paul. So let's say if you have any questions, feel free to put in. If not, we will be waiting for another 1 minute. So if you don't have any questions, then we will end for today's session. All right. Okay, let me see. Okay. So Paul, just to check, right? So because right now is also going into September already. So any views on the next quarter and also upcoming on 2026?
Um. Okay. When the next, okay, the problem for some of these small mid caps, at least in Singapore, is that they don't they don't give quarterly results. So what I worry is that without the news flow, you might get a bit of lull in the market in the very near term.
Mm.
Because you need news for the momentum. So I think when the next 2.9 sorry 3.9 billion is farmed out, I think the market will get excited again. Yeah. So
All right.
so my view is stick to construction stocks and yeah, because that's the area that has semiconductors is a bit tricky because um the impact of tariff, a lot of front loading of electronics. So we're not sure where is the underlying demand, and the US economy is slowing too. So we're just a bit more wary on semiconductors. So that's why we are more focused on domestic related sectors. Yeah. Okay. I do see. What's your view on Centurion? Yeah. Uh okay. So for Centurion, I think we have a target price of about $2. I think the share price might probably get one more lift once the REIT is done. Then they might dividend in specie the Centurion IPO. Then I think after that, I think the valuations look pretty steep for me. I think yeah, my own view on Centurion. I think once you hit our target price, if you notice our target price, we raised the valuations like almost 20 times PE, including our fund management. And the big catalyst is the upcoming REIT. I think once the REIT is done, some dividend species, I think you probably might kind of maxed out on that stock. Yeah. Although the environment is still positive, they had a new DOM, a thousand bidder. If don't hold me to the numbers, or sometimes I think it's 1,006 or 1,002. They had a new DOM in Singapore, and it was filled up in just 4 months, completely filled up. So the environment is still positive for them. It's just that the valuations might be a bit stretched in the near term. Yeah, especially after the REIT. Yeah.
Okay, so there are two questions. Maybe we take last one questions. For which one do you prefer?
I guess we cover capital infrastructure. We don't cover. Yeah.
Okay.
For view of Viher, we are still positive, I think, because they still have a lot of assets to sell. They still have they are constructing a new 10,000 bedder dorm in Singapore, so that will give them the growth. And they still have two portfolios, Australia dorm portfolios that they can monetize. I think combined could be maybe 500 million. Or 400 to 500 million. They have still an existing state in the fund. They still have an existing state in Fund 1, and they have some new DOMs that they haven't sold yet. So, and there's already platform to buy the private fund that bought the initial batch of student DOMs that they have. So I think there's still a few more catalysts for Viher. Yeah.
Okay. All right. I think right now it's already 9 already. So thank you so much, Paul, for today and to share all this information. So let's say if you have any questions, feel free to reach out to Paul, and there's a Telegram from the Telegram group, right? You can also reach out to them as well and ask a question there. All right. So once again, thank you so much, Paul, and we will see you in our next webinar.
Okay. Yeah. Thanks everyone. Thanks for your time. Yeah. Thanks Darren and InvestingNote. Bye.
Hello. Hello, Paul. Hello, Paul.
I think I think could be your connection. Yeah. Anyway, thanks everyone for your time, and yeah. Thanks Darren and InvestingNote. Bye bye.
Hello.
Yep.
Hello. Hey,
Yeah.
hi
Yeah.
Paul. Hi Paul.
Yeah.
Yeah, I think my line just cut off, but thank you for joining for this session. Thank you so much. So we will end today's session here.
Okay. Thanks everyone. Take care. Bye.
Thank you. Bye bye. Thank you so much.